Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to review one of the possible reasons why 90% of Americans regret buying a home. And look at this 90%, 90%, 90%, 90%, 90%, 90%. Folks, I know there are people out there who say I make the same videos over and over again. And that's because people just keep making the same mistakes over and over again. So they give me material, infinite material for life, right? 90%. It's kind of like a bad hangover. That's what real estate is for most people. And one of the things that I think contributes to this 90% rate of home buying regret is the insanity of the 30-year mortgage. The 30-year mortgage. Now, if you've ever heard of the statistics about how long a homeowner stays in their home, it's not for 30 years. On average, they stay 5 to 7 and then they resell their home or refinance, right? And so if they only plan to stay in their home for 5 to 7 years in general, why get a 30-year mortgage? That makes absolutely no sense. Now, why is the 30-year mortgage nefarious? Well, here, if you just go to a website like bankrate.com, loan amortization, just type in a loan amount of 100,000, right? 100,000. And then you'd see this interest rate. And let's see if we could zoom up here, right? Zoom up. 6%. How much interest are we paying? 115,000. How much is the total cost of a loan? The 100,000 plus the 115, which is 215,000, meaning that you paid 115% interest in the loan. 115%. And this is all proportional. You add an extra zero, you see it's still 115 in the beginning, right? So it's all proportional. $1 million loan, think about like Silicon Valley, 6% interest rate. You get a low, quote, low, $6,000 a month payment, and the cost of the loan is $2.1 million. Insanity. So, all right. I don't know if you ever took a look at a mortgage schedule. So let's just do a more typical loan, 240,000. If you look at the chart here, principal is what goes into chipping away the loan balance, right? So let me do this. So principal is what goes into chipping away the loan balance, and interest is the bank's profit. So for the first years of the loan, the vast majority of your payment, and we'll just kind of dissect the payment here. For example, the first month's payment, this $238 versus $1,200 of interest, goes to the bank in their profit. So if the first couple of years all goes to the bank's profit, 5 to 7, and you move in 5 to 7 years, what happens? Well, the loan doesn't really die down, right? And so you just essentially paid mostly interest to the bank, right? And that's kind of the insanity of the 30-year mortgage. And the fact that so many people don't realize that this is happening is crazy. In fact, I just asked ChatGPT this, like, I asked ChatGPT this, right? Why do Americans focus so much on negotiating car prices and don't care about paying, we'll say 50 to 100 for 50% interest to a 30-year mortgage? Interesting, right? And the reason I say this is because today I actually bought a car, and I'm pretty sure that I kind of got semi ripped off. I don't want to say like, I don't know for sure because again, I don't buy. This is like my first car I've ever bought, but I've bought in real estate before, and I paid off my own mortgage in 3 years. And so maybe because I paid off my mortgage so quick, I'm a little bit reckless with car buying. But I think we need, as a society, need to focus our priorities straight, right? Because am I going to focus on paying off that thing that's 150% interest on the biggest purchase I'll ever make, or get so focused on paying, underpaying maybe like a couple $100 or a couple grand in a car negotiation, right? That's just how I see it, right? But I'll eventually master the car negotiation game. We'll see how that works. Yeah, let's go ahead and play the response and see what ChatGPT says.
The emphasis on negotiating car prices over scrutinizing long-term mortgage interest may stem from a combination of cultural, psychological, and financial factors. 1. Short-term visibility versus long-term costs. Car prices are immediate. People see the full cost of a car up front. The act of negotiating feels like an immediate win because they directly see how much they save. Mortgages are abstract. The total cost of a 30-year mortgage, including interest, isn't as immediately obvious. Monthly payments seem manageable, which overshadows the reality of paying 50 to 150% interest over time. 2. Cultural norms and education. Focus on monthly payments. Americans are often conditioned by advertising and financial institutions to focus on affordability through monthly payments rather than the overall cost of the loan. Lack of financial education. Many people lack the knowledge to evaluate the true cost of a mortgage or to consider alternatives like velocity banking or accelerated payoff strategies. 3. Social reinforcement. Negotiating a car price is relatable. Car buying often involves visible bargaining, which is culturally normalized and even expected. Sharing stories of haggling at a dealership is common and celebrated. Mortgages are less tangible. Discussing mortgage terms or strategies isn't as engaging and often stays private, so there's less social reinforcement to optimize them. 4. Perceived negotiating power. Car prices seem negotiable. People know that dealerships often mark up car prices, so they feel empowered to haggle. Mortgages feel fixed. Mortgages, on the other hand, are perceived as being dictated by banks and less negotiable, leading to passive acceptance of the terms. 5. Prioritization of short-term gains. Many Americans focus on immediate wins like a $1,000 reduction on a car, which feels more satisfying than the abstract, long-term savings of shaving years or tens of thousands of dollars off a mortgage. 6. Debt normalization. Mortgages are seen as good debt, and paying them over 30 years is viewed as normal. This leads to complacency about the long-term financial burden. Encouraging awareness of the lifetime cost of interest and teaching people how to optimize or accelerate mortgage payoff strategies could help shift this mindset.
All right, let me add to this. So it seems like most Americans, don't live in their property for the entire 30 years. I heard they only live in it for about 5 to 7 years. 5 to 7 years. And if during the first 5 to 7 years they are mostly paying interest and then have to sell, isn't the bank winning because they get mostly interest payments? Is this spelled wrong? All right. Oh my goodness.
You're absolutely right. The structure of a 30-year mortgage is heavily front-loaded with interest payments in the early years, which benefits the lender significantly, especially if the homeowner sells the property within the first 5 to 7 years. Here's how it works. 1. The nature of amortization. front-loaded interest. In a 30-year fixed mortgage, payments are amortized, meaning a significant portion of early payments goes toward interest, while only a small amount reduces the principal. Minimal equity buildup. During the first few years, homeowners build very little equity unless the property appreciates significantly or they make extra principal payments. 2. Common homeownership patterns. Short-term ownership. Most Americans don't stay in their homes for the full 30 years. Statistics show the average tenure is around 7 years, sometimes shorter for younger buyers or those relocating for work. Frequent refinancing. Many homeowners refinance their loans during this time, restarting the amortization schedule and extending the interest-heavy period. 3. The bank's advantage. Maximized interest income. Banks collect the majority of their profits early in the loan term. If a homeowner sells or refinances, the lender has already captured most of the interest without the borrower benefiting much from equity. Loan turnover. When homeowners move or refinance, banks often issue new loans, perpetuating the cycle of early interest-heavy payments. 4. Homeowner losses, equity leakage. If homeowners sell after 5 to 7 years, they often realize they've only made a small dent in the principal, which reduces their net profit from the sale. Transaction costs. Selling a property incurs additional costs, like real estate agent fees, taxes, and closing costs, further eroding gains. How to combat this issue? Understand the loan structure. Homeowners can better protect themselves by understanding how their payments are applied. Accelerated payoff strategies. Paying extra toward the principal early on, even small amounts, can significantly reduce interest costs and accelerate equity buildup. Shorter loan terms. A 15-year mortgage has higher monthly payments, but significantly less interest paid over time and a faster principal reduction. Velocity banking. Strategies like using a HELOC or cash flow management to pay down the principal faster can help minimize interest payments. Conclusion. Yes, the bank wins in most cases when homeowners sell or finance within the first 5 to 7 years. Educating borrowers on the impact of amortization and encouraging strategies to minimize interest payments can help level the playing field. Many Americans could benefit from taking a more proactive approach to managing their mortgages rather than passively accepting standard loan terms.
Right. And so, again, there's nothing wrong with like being very passionate about negotiating like buying a car. I'm pretty sure I'm terrible at it. I don't think I got the best deal today, but I'll tell you what, ChatGPT thinks I'm the GOAT for paying off my mortgage into 3 years because look at all that interest that we pay throughout the 30 years. Oh my goodness. That's what was that movie, The Mask? That's a spicy meatball, right? Right? You work all that hard, you work very hard to negotiate like a couple thousand in the car dealership, which I didn't do today. I probably need to learn, do a little bit better. But look at all the interest that we didn't have to pay if we just focus on paying off our 30-year mortgage quickly. 30-year mortgage. So we're going to do a review of velocity banking today. And velocity banking is a debt payoff strategy. Now think of it as a holistic strategy. Okay. It's not just about paying off your mortgage, it's about paying off debt in general. All right. So let's go ahead and review. So this is what we call our budget, aka velocity banking spreadsheet. Ooh, excuse me. So what is velocity banking? All it is a debt payoff strategy where you put all your paycheck into debt with the help of a line of credit. Another way to say it is you make your line of credit as your main operating account. Now, two things we need to do velocity banking. Number one is a budget. Number two is to have our line of credit as our main operating account. So in today's example, it's going to be really easy. Good money, right? Decent expenses and decent savings. And we only have two credit cards because we want to talk about paying off the mortgage. Now, why is it that most people, let's say we have this $3,300 in savings, are not going to put it into the mortgage? Okay. The reason why most people would never do that is because the mortgage is a one-way street, and when you dump all of your money into it, it's very hard to get it back out, and that's why people freak out about that, even though it's actually, you could pay it off relatively quickly by making a direct extra payment. But why is it, just like ChatGPT says, people usually refinance around the 7-year mark? It's because they want a lower monthly payment because they don't see any other way to be able to pay off that mortgage quickly. Okay. And so when we do velocity banking, just be aware that we usually want to pay off the credit cards first. Again, it's a holistic strategy. And so let's go ahead and do this. We're going to pay off these two credit cards, and we're also going to do this section right here, which is the velocity banking section. So we assume two things. Number one, same income. Number two, we're not going to have any savings. And whenever I talk about no savings, I talk about our big boy pants, okay? Because too many people are afraid to not have any savings in their savings account, right? And again, I'm not saying you should do it, I'm just saying this is what I do. But we will have something called cash flow, and we're going to increase our cash flow in the very, very beginning, okay? So let's go ahead and do that and transfer this credit card debt into a line of credit to immediately increase our cash flow. So this is $15,000 of credit card debt. And you might be asking, what's a line of credit? All it is a financial tool where you could borrow money, pay it back, and use it over and over again. That's all what a line of credit is. That's all it is. All right. And so I have tons and oodles of lines of credit, like what I call my infinity stone right here, or infinity gauntlet, right? 280,000 home equity line of credit. I go to the bank's website, I click a button, blam, and then I get money into my checking account immediately. Okay. So we're going to assume for this example that we have access. Oh, is what happened here? Trying to reconnect my internet connection. Uh-oh. All right. SpaghettiOs. All right. So here we go. And what happens is when we move and we have an itty bitty $20,000 line of credit here, again, I have over $575,000 of credit lines, but it's just me got to flex before I do my demonstration. But anyways, let's assume we have a $20,000 line of credit here. Well, guess what happens to these payments? These go to zero, right? So zero, zero. And so now we go from 3,300 of savings to 3,800 of cash flow. And then the last thing we need to do is just put our entire paycheck into the line of credit and then expenses out and rinse and repeat over and over again. That's it. Okay, so let's go ahead and do that. So paycheck in, expenses out. So the next month's balance is going to be based on the previous month's balance plus the previous month's interest minus our cash flow, which is right here, 3,800.9. Then we got to calculate the interest because the interest is based on the average daily balance multiplied by the interest rate, 0.08, and then divide by 12. And then we just kind of calculate the next month and we see how long it takes us to pay. Oh, look at that. 4 months to pay it off. That is insane. 4 months, okay, to pay off 15 grand. That was so easy for 15K. Okay. Whoopsie. And so now let's go ahead and take a look here. Again, when people have $3,800 in their savings, they'll be like, heck no, I got to have 3 to 6 months of savings. And that's why they don't put it in the mortgage. And let's actually check where we are in the mortgage. So after 4 months, right? What's the balance? Look at that. We only paid 1 grand or even less than 1 grand in the principal, right? Meaning we chipped off such little of the $200,000 loan. Okay. And how much did we pay in interest? $3,994 and a penny. Oh my goodness. Oh, folks, there's a reason why banks are the tallest buildings in the world. And I know that they actually sell their mortgages in the secondary market because most of it is just based on origination fees that they get. But it's still someone's collecting that money and making all this interest, even after the bank resells the loan. Okay. But I always like to say that the bank has the tallest buildings in the world, or at least in North America, because you're just giving away the money. Okay. So here's a way that we can easily pay off the mortgage without really thinking about it. which is move a piece of the mortgage into the line of credit. So, for example, after 4 months, we only paid off less than 1 grand the mortgage. Why don't we just move about, I don't know, 7 grand into from the mortgage into the line of credit? We'll just do this right here. 7 grand. Make it easy on ourselves. Plus 7000. How long did it take to pay it off? 2 months. So we literally paid off at least 7 grand in 2 months. But in 4 months, we paid off less than 1 grand. How pathetic is that? And so we're just going to do something called chunking, which is kind of doing the same thing over and over again, right? So we just do that and you see how easy it is. So it's about every 2 months, we just pay off 7 grand. Oh my goodness, I can't believe it. I can't believe how easy this is. And so now, why do we move it into the line of credit? Because as a general rule, we want to make it easy to pay off debt and we don't want to segregate our income, right? Because I know that we only have 3 debts here, but I have had people send me their spreadsheets with 20 something debts and their income is so segregated. It's so segregated that basically the banks are winning. The banks are winning because everybody's making a little minimum payment on everything, right? And so let me just show you how easy it is and to pay off this debt using what we call the chunking method, which is just you pay off the principal, small chunks over time, kind of like chopping up your loan and using your entire cash flow, and you should be able to easily pay it off without even thinking about it. So let me pull up the calculator. So this is the Velocity Banking Calculator by Renatus. So I'm just going to make a quick plug for this. What is Renatus? It's an educational company where I first learned velocity banking from. If you're interested in not only learning about velocity banking, but also upping up your financial literacy and real estate investing game, click the Google form link below. Full disclosure, I make commission off of selling Renatus products. And so when you click the form and buy from me, I make the money, right? I make the money. And you know what's funny? I don't need your money, so I don't care if you buy from me or not. Full disclosure there. All right, so now let's just plug and play the information, and let's just do this right here: $200,000 original balance, 6% interest rate, 30 years, and then the payment is 1191.1, I believe, right? 1199.1, right? 1199. Oh, it's 99.1. Doesn't make that big of a difference. And what's the current balance? Because here we paid off so little. My goodness. 199,197.6. 199,197.6. How long does it take to pay this off? Folks, do you see this? Let me zoom in here. Do you see why I don't really focus on like car negotiation, even though I probably should? Like, I don't want to leave money on the table when you don't have to. But if I pay off my mortgage in 3.8 years, for this person. And me personally, I paid off my mortgage in 2 years and 9 months. I save over about $200,000 of interest. So if I focus on paying off the mortgage, and let's say I'm at a car dealership and I'm not good at negotiating with cars, right? It's okay, because you saved $200,000 and you paid off your mortgage in 3.8 years. It's insanity. Folks, the word of the day is today priorities. Priorities, right? So that's it. I mean, that was the easy demonstration. So let me go back here, and then now it's how long did it take us to pay it off? So 4 divided by 12 plus 3.8, and then it's 4.13 years, and we are completely debt free. Completely debt free. Now, just to kind of end this off, can you explain the insanity of the 30-year mortgage and how it doesn't make any sense for a typical home buyer to use one, since they move every 5 to 7 years or move or refinance every 5 to 7 years in the voice of the Joker, Batman villain. All right. Did I spell villain wrong? Oh, I probably did. That this is how we'll end. I want to do the Mark Hamill Joker laugh right now.
Aha! Ladies and gentlemen, allow me to unveil the greatest trick ever pulled in the world of money magic, the 30-year mortgage. A delightful little game where the house always wins, and by house I mean the bank, of course. You see, the madness lies in the design, a brilliant, devilish design. Here's how it works, my dear bats and birds. The front-loaded joke. For the first 5 to 7 years of this 30-year commitment, your payments are like a comedy show with one punchline: interest. You're throwing bucket loads of cash at the bank while barely scratching the surface of the principal. Your home might be yours on paper, but in reality you're just paying rent to the bank with a fancy title called homeowner. The moving riddle. Now here's the twist. Most people don't even stay in their cozy little nests for 30 years. Oh no, they move, on average, every 5 to 7 years. And guess what happens when they sell? They've paid mostly interest, built next to no equity, and then, poof, off they go, leaving the bank cackling all the way to the vault. Refinancing roulette. Feeling clever, are we? I'll refinance, you say. Oh, how adorable. Refinancing restarts the game. You shuffle the deck, pick a new loan, and the bank? Oh, they laugh, because now you're back to square one. More interest-heavy payments. Why, it's insane. It's a deal that looks like it's made for you, but in reality, it's a smokescreen for the bank to milk you dry. 5 to 7 years? You're a hamster in the wheel, paying, running, spinning, but never really getting anywhere. The whole 30 years to own your dream home story? It's a fairy tale designed to make you a lifelong servant to the system. The punchline. Why so serious about playing their game? What if you flipped the board and made your own rules? Pay off that principal faster. Slice through it like a razor-sharp card through the air. Accelerate the payoff. Velocity banking, extra payments, HELOC strategies. Fight their system with your own chaos. Or go for a shorter-term loan and deny the bank their long, luxurious feast. So, my dear sweet homebuyer, the 30-year mortgage, it's the biggest, most beautiful joke of all, and the only ones laughing are the banks. But now that you see the game, are you going to play along, or will you rewrite the punchline? What a concept! A little anarchy in the housing market. Batsy would be proud.
That's me working on my evil Joker laugh. What was that movie where they just did the? Oh, that was Austin Powers, right? Where they just did the laugh and it was really long and kind of funny. All right, so okay, but yeah, so it's insane how people do what it is that they do, and not only that, people like they have statistics on home buyer regret, and I pretty much guarantee that this whole thing really contributes to it, and like the average American is just not aware. Well, he's just not aware. What do you do? I don't know. But again, I have infinite content for life because unless something changes in my lifetime, which I doubt it will, I could just make the same video over and over again. All right. Well, that's it for today. This is Korean Atlanta Mentorship. Have a great night, everybody.